I'm so glad you've joined us here on the Clark Howard Show. You know, our mission is to serve you with advice and information that empowers you so you make better financial decisions in your life. One financial decision that can be so confusing to many of us is where to invest the money that we're saving for our future. And how you do it can make a big difference over time, what you end up with in life. I'm going to explain something straight ahead that puzzles people, but it's important you understand the difference between two forms of investing that are generally not well explained. Hopefully I'll do a decent job. And later, take it from me, pets can be expensive. So I want to tell you there's a plan that a lot of vets are offering now that could be okay, but often ends up as an ugly, mean-spirited ripoff. But right now, I want to talk about your money. And I want to talk about something that is actually something that professional institutions, professional money managers use routinely, but nobody ever bothers really to explain what they are to everyday people trying to put money aside for their future. And it's what an ETF is versus a mutual fund. A mutual fund is where you are pooling money with a bunch of other people, and the mutual fund shares you own, although there's more than one kind of mutual fund, but the most common kind is where you're pooling money, which is why it's called mutual fund, and the money is like its own thing. That mutual fund is its own thing, except at the end of the year, when even if you keep owning it for the future, it can hurt you to be in a mutual fund outside of an IRA, outside of what's the equivalent of mutual fund shares, inside a 401k or something like that. But if you have just a regular investment account with a discount broker or a regular, and you own mutual funds in it, in a regular investment account, you are hit with what's known as a tax on phantom income. What does that mean? So when you sell something, when you sell an investment, you owe taxes on your gain. But in a mutual fund that's held inside an investment account, not a retirement account, but inside an investment account, that mutual fund declares what's essentially a form of a dividend that's not paid to you, but generates an ugly tax bill for you, even if you aren't selling any of it. So a newer form of investing that works a little differently, called an ETF, an exchange-traded fund, fastest growing part of the investment market. Originally, it was really only for, again, big institutions, big money managers, very wealthy, sophisticated investors. It's where you buy something like a mutual fund, but you buy it like buying a share of stock. So just like you'd buy a share of Apple, buy shares of Apple, you can buy shares of an ETF fund, an exchange-traded fund. I just was redundant. I was saying ETF fund, exchange-traded fund. And the tax treatment, particularly outside of a retirement account, is more favorable to you because it generally will not create a phantom profit that you have to pay tax on each year. Plus, you can buy and sell it at any time, just like you'd buy or sell Apple or Alphabet or any stock. Gosh, I did go right there and name 2 technology stocks. Oh, well. Anyway, so people that are traditional investors in a regular investment account suffer owning traditional mutual funds. So am I telling you to sell those and then buy a replacement ETF? No, because then you're going to generate tax on income you're not having again. You're just moving it over. Now, sometimes there will be a tax-free exchange you can do where you go from the mutual fund shares into the ETF equivalent. And if a company like Vanguard is offering an opportunity like that, they'll tell you. And they'll make that available to you. I'm not smart enough about tax to understand how that happens. That's a tax-free exchange. But anyway, that is something you can do. But the big news is for future investing in an investment account, not in a retirement thing like an IRA. You want to buy the ETF equivalent of the mutual fund you love. Normally, it will have lower ongoing management expenses because they don't have to do all the paperwork they have to do with the mutual fund. It has potentially, likely better tax treatment, and the buying and selling of it is so easy. And so that is a nutshell explanation of an exchange-traded fund. It is virtually identical to the mutual fund you'd own, except how you buy it, how you sell it, and how it's taxed. Period. That's the simplest way I could ever explain it. And I can't wait because I'm sure there will be professional investors who say I should have said this other thing and I don't like quite how you said that. And I'll share some of those. I'll amplify it when those come in.
Okay. Jeffrey in North Carolina sent this question in for you, Clark. He said, following your advice, I opened our family HSA with Fidelity, but my employer uses another company, one of the quote-unquote bad and ugly providers.
That's what I called them, didn't I?
Mm-hmm. My employer contributes $1,500 a year, and I fully fund the rest. Until last fall, I could move the money from the bad company to Fidelity for free through their portal. Now they've disabled that option and forced transfers from Fidelity's side. When I did that recently, the company deducted, not Fidelity, the company deducted a $25 processing fee without warning, and the transfer still took 3 to 4 weeks. I used to transfer every few months to keep only a small balance with this company. Now I'm wondering, should I limit transfers to once a year to minimize fees, or is there a better way to deal with a provider that seems designed to trap your money?
What a wonderful question, Jeffrey. This is an ongoing tug of war. Employers busy running their business often end up ripping off the principals of the business and their employees by not understanding the really ugly underbelly of employer-provided HSA plans that, as a general rule, are atrociously anti-employee. And by the way, if an employer is in it and has probably more money in it than other people, the employer, the owner of the business, is being harmed. The harm to them is magnified over what it is for their employees. And so if you're a business owner and you're not aware that you may have an HSA plan that is ripping you off and ripping your employees off, time for you to know more about it, because these generally the employer-provided plans charge huge fees, offer terrible benefits, and then to add salt to the wounds, when you say, hey, I don't want to have my money there, and you move it out, now charging you a junk fee and slow walking the moving of the money. So your answer is what you supposed, and that is you only do a transfer once a year so that the fee isn't a big drag on your money, the $25 junk fee that they'll probably keep moving up as a way to try to discourage people from moving their money out to a ethical low-cost provider like Fidelity instead of these unethical HR kind of companies that come in and offer HSAs.
I have a question.
Yes.
Could you just put the amount the employer matches, what was it, $1,500 into the employer one, and then separately have money put directly into your Fidelity HSA?
I think it depends on the plan documents, but what you said is actually a statement and a question. There are people who do just that. They take the free money that the employer puts into the crummy HSA provider and then fill out the remainder with a good provider.
Okay. Cory in Ohio says, we need some guidance determining what we should do with our term life insurance. My wife and I both purchased 20-year policies 5 years ago when we first got married. Fast forward to today.
That's awesome that you did that.
I know.
When you got married.
Fast forward to today, my income has doubled.
Even more fantastic.
And we now have 2 kids under 3 years old.
Oh, boy.
Well, that's even more fantastic.
When do you sleep and 2 kids under 3?
Everything was fantastic until I told you that.
Yeah.
Congratulations on the kids.
Yes.
We'd like to add additional coverage for my income. Is planning for the 2 combined coverages to be 12 times my current salary sufficient, or should we plan ahead as I expect my income to continue to grow? How long should the new policy be if I'm 31 and we expect to have additional children over the next 5 to 10 years?
Okay, what a wonderful question. If you medically underwrite for a new policy, this time buy 30-year level term policies. You can leave the existing ones in place to run their course for 15 more years because they were 20-year, right? Mm-hmm. And have that boost of coverage when your kids are really young. The ones you're talking about would still be just emerging as quasi-adults by the time that one would be up. And then you'd have the 30-year with more value that would carry you into your early 60s and would provide till these children and others you might have made it to adulthood. So the choice is yours. You could either buy a 30-year for more money in it that would cover your anticipated future income and let the other one lapse. Or I think it's a better idea to keep both in place potentially because you bought those actuarially when you were younger and your actuarial risk was lower. The premiums are probably crazy good on the one that's 5 years in place.
And David in California says, I am self-employed as a freelance consultant. My wife is employed by a hospital system, and it's through her that I have my health service plan. It's not called an insurance plan, as it is self-provided and self-paid. I have learned that they offer a flexible spending account, but not a health savings account. I have also been told I cannot open my own health savings account as I cannot prove I am in a high-deductible insurance plan. I feel like I'm missing out on this great tax shelter opportunity. Does this sound correct to you, or is there a legal way I can get into an HSA?
The only legal way you can do an HSA, well, there's 2. One is buy your own health coverage, bad idea, because being able to free ride on your wife's plan is just way too valuable. So that would be number 1. Number 2 is at some point, like most employers have in the country, the hospital system will end up offering a high-deductible HSA-eligible plan at some point, and then you want to do that. Now, FSAs are a pain. They are vastly inferior to health savings accounts. But if you know that there's normally in your life a certain amount of medical bills you're going to have over the course of a typical year for yourself, you can contribute to the FSA, and then you're using pre-tax dollars for the out-of-pockets that you face on eligible medical expenses over the years. So the FSA is way inferior to an HSA, but still valuable if you know that there's a certain amount of predictable health expenses you're going to have to pay out of pocket each year. Because remember, you're paying with pre-tax dollars, which make those FSA dollars much more powerful. The FSA use it or lose it provisions with it. I mean, for so many reasons, when Congress did all the stuff with HSAs, they should have updated the terms and conditions of FSAs to make them more customer-oriented. There are people who believe the reason that didn't happen is because of industry lobbyists for big companies, because unused FSA money goes back to your employer, and they just get free money from you, and you essentially take a pay cut. And that's why FSA money is such a poor choice if you have the alternative of the HSA you don't have. So let's hope that employer decides at some point to offer that high-deductible HSA-eligible plan for you. Coming up ahead, I mentioned at the top of this podcast and YouTube show, I've learned from personal experience how expensive pets are. And there's something a lot of vet practices are offering that could be a benefit to you, but often could also be a trap for your wallet. I'll fill you in. I want to talk about something we've been hearing a lot of complaints about in our one-on-one advice center, the Team Clark Consumer Action Center. And it's something that Krista of our crew has had the experience herself. Mm-hmm. Veterinary medicine practices are very often selling, instead of pet insurance, they're selling the opposite of an illness policy. They're selling wellness policies, not through an insurance company or anything like that often. They're selling them themselves. Larger chains, a lot of them owned by private equity, are selling these wellness plans, and then some standalone vet practices sell wellness plans too. But what you got to watch out for, what these things do is you pay a monthly subscription, and they pay for what I call well baby visits. Kind of like, you know, with a kid, a small kid, when you go in the pediatrician regularly and they're doing their well baby checkups.
Vaccines.
These plans pay for the equivalent of well baby for your pet. When your dog or cat or whatever animal has to go for their regular checkups, these policies or plans reduce the bill shock of those visits. And depending on the contract and what it covers, it may make certain visits, dare I say, not free. I'll say no cost at that time because you're already prepaying it through the contract for the wellness plan. All right, so let me tell you what we're hearing repeatedly that you need to know. So the lifespan of pets generally, tragically, is not that long compared to the normal human lifespan. So these plans that you sign up for continue, and you are legally liable to pay if your pet passes away. The bill does not stop.
Right. Usually they're based on one year at a time. That's what happened to me when Mr. Snuggles passed away, my little dog. And
so there you are. You're already grieving the loss of Mr. Snuggles. Mm-hmm. And is that the dog that never liked me?
Stop it. You say that about every dog. You're ridiculous.
That you've had. And then you get hit in the face with a bill reminding you that you've lost your beloved pet. And how crooked, dishonest is it of these chains that they would treat somebody like that? I mean, it's just disgusting.
Yeah, I had to keep paying it every month for like 6 more months.
I mean, that is so rotten dishonest. And and I'm always trashing private equity, sorry. It just seems that these kind of practices happen a lot more often with private equity-owned enterprises than they do with particularly a family-owned or an individually-owned business. So that's why I said it. We had a Clark Stinks before from a friend who was upset with me about what I say about private equity. But the point is simple. Just understand that the shiny brochure for these wellness plans will gloss over, or the brochure won't even mention this gotcha with these things, that you're billed long after your pet may have passed away.
It does say it in the terms, so you really need to read the terms. Like anything else, you got to really read through it. I didn't pay attention to that, so that was
But you know
my bad.
forever now.
Oh, yeah. But it's complicated because they are expensive, like you said. Okay, we'll go to some questions. Christina in Florida sent this one in. I'm currently trying to rebuild my credit after abandoning my credit card bills and usage 2 years ago. This past summer, I was able to pay off all my collections, leaving me with zero debt.
Oh, Christina, that's fantastic.
It's amazing.
Oh, that's great.
I recently applied and was approved for a credit card with a $1,000 limit, which I intended to use only sporadically for gas and then pay it off as soon as the bill came in. I've done this twice over the last couple of months, but the other day I got an email stating that my credit score went down. Plus, my score hasn't moved since before paying off all the collection companies. How is someone like me able to rebuild my credit score back up without making big or multiple purchases? I don't want to fall back into a trap where I have any lingering debt. I only want to build my score to have better options for purchases that require a good score, i.e. a home or vehicle. Thank you for all of your help navigating the world of finance and consumerism.
So first of all, Christina, fantastic on your part that these cards that had fallen into default, delinquency, whatever they were, you did the hard work, you got them paid off, it really messed up your credit, and now you're trying to rebuild it. You did the right thing already, getting that card, and $1,000 limit is fantastic. You didn't say if it was a secured card or a traditional credit card, but let's talk about your score. So the collection stuff from before sticks with you for a good while, but the significance of it on your credit profile will steadily fade. It's a slow fade, not an automatic fade. Second, when you applied for a new card, that will temporarily lower your score. Your use of that card will be part of the process of rehabilitating your credit and credit score. You never want to use more than $300 of the available $1,000. And if you can, you want to pay it off in full each month so no interest is charged, and it keeps your utilization, the percent of available credit you're using, very low. I'd like you also to set up a Credit Karma account. It's free. And you'll be able to monitor your credit, and they will also guide you on what are the things that are lowering your score, what are the things that are raising it. And instead of feeling like you're flying blind without a map, you'll be able to see from it what are the things that are going to keep moving your score steadily higher, what are the things that might bring it down. Credit scoring is kept very mysterious by the banks. They love that, keeping it a mystery, but it's not really a mystery. There are certain factors that make up your score, and two in particular represent roughly 2/3 of your score. That's paying bills on time every month, which you're doing moving forward. And the second is keeping the amount of credit you have that you're actually using down at 30% or below.
Okay, and Milt in California says, my question's about my Southwest Rapid Rewards credit card. Are there advantages to having more than one Southwest credit card for a married couple? My wife and I each have our own card, but I never use my card. We usually travel together 2 or 3 times each year. My wonderful wife handles all the flight bookings and charges Southwest flights to her card. I just paid the $95 annual fee for my card that has not been used for any purchases. I fail to see any reason to keep my card and considering canceling it. I would be glad to keep it if there was an advantage.
I don't know that there is an advantage, Milt, and now that you've just renewed it, you need to put on your paper calendar or electronic one a reminder that 11 months from now is when you cancel it. Now, Southwest has suffered a lot of reputational harm with the ownership change they went through. And when you go to cancel the card, you may, as we've heard from other people, be offered a big discount or even no annual fee for another year. If when that time comes that you're thinking of canceling, if you're offered another year free, there'd be no harm to just doing that, as long as you then note again on your calendar to cancel it a year later. And Krista, we have not talked about how much fuss there's been since seat assignments went into effect in late January. Southwest is getting pummeled out there for totally botching seat assignments. But as I read from an industry analyst, in 60 years, they've never had seat assignments. And there's a certain amount of Keystone Cops expected from them in how it's being implemented. But there's one change they got to make. So if you didn't buy a premium, extra legroom seat and one's open, you can't move to it. None of the airlines let you do that if it's just open once the door closes. But Southwest has given very bad direction to their employees, or they mean for them to do this. If you're in regular coach and there are some seats open after the door closes, they're not letting people move to those other seats. I mean, do you want your customers to hate you and become ex-customers? What's that about?
Oh, that's not fair to the flight attendants.
Yeah, because the flight attendants are being made into the seat police.
Right.
How dumb.
Okay, Matt in Illinois says, "Hey, Clark, thanks to you, I've stopped mailing checks.
Yay.
But unfortunately, blank checks with my name on them are still in the mail. You probably know what I'm referring to. These so-called complimentary checks that come with balance transfer offers. A bank has sent me these blank checks multiple times in the last year, and I think I might just end my relationship with them rather than try to fight through the customer no service to pause these solicitations. Am I correct in thinking they're dangerous?"
Absolutely not dangerous like a check that you write on your own account. These balance transfer checks that come unsolicited, the number of banks that do it seems much less than it used to be. But banks still do these, and they are unsolicited mailings. If that is intercepted and somebody passes that check, it does not have the same risk to you that you have with a check that you originate and you write. So they do get intercepted from time to time. As long as you seem like you're very, very diligent about your money. If you're looking at your statements from this bank and you see something that's like, what is that $500? And you figure out it's one of those, you have clear rights under federal law to dispute that, and the burden is on the bank, not on you like it is with a check that you write and you originate by sending out. So of things that I would fret about, I'd say those balance transfer checks and those checks, just write them and we give you money kind of thing. Those are not a high priority in my book for you to worry particularly about. And thank you so much for joining us today. I hope that something today was something you thought, oh, I didn't know about that. Oh, I'm glad I heard about that. And that you share something that is useful to you with a friend or family member who you think could benefit from it as well. Because we're all in this together. We all learn from each other. We all empower each other. And I want to thank you for sharing the word, spreading the word, so that others can become more powerful in how they handle their money. So they will learn ways to save more, spend less, and avoid getting ripped off. And I'll be at your service on Wednesday.